If you had put $1,000 into Amazon almost 3 decades ago, you would be looking at a fortune today. That is the dream that traps most people. They look backward, they find one monster winner, and then they spend the next 20 years trying to locate the next one before the rest of the world sees it. Most of them never do. A few get lucky. Most lose money, lose time, and lose confidence. They are not investing anymore. They are hunting lottery tickets with better branding. I have spent my life watching people make the same mistake in different clothes. They imagine wealth is built by finding one miracle company before the crowd. They imagine the whole game is prediction. It isn't. Real wealth for most people is built by owning broad productive assets. Sitting still and letting time do the heavy lifting while other people burn themselves out trying to look clever. That is why I want to walk you through 3 exchange-traded funds that, in my judgment, have made more ordinary people wealthy than almost any single stock ever could. Not because they promised excitement, not because they gave people something to brag about at dinner, but because they solved the biggest problem ordinary investors have, which is this: they do not know which single company will dominate the next 10, 20, or 30 years. An ETF gives you a different game. When you buy one stock, you are making a concentrated bet on one management team, one balance sheet, one industry, one future. When you buy the right ETF, you are buying a basket of businesses. You might get exposure to a company like Amazon, but you also own Apple, maybe Coca-Cola, maybe McDonald's, maybe a semiconductor business, maybe a healthcare company, maybe an oil company. You are no longer trying to guess the single horse that wins the race. You are owning part of the racetrack. That distinction matters more than most people realize. I want to be clear before I go any further. You should never hand your money to any person on the internet, any television personality, or any smooth talker, simply because they sound confident. Investing has risk. You will see declines. You will at some point look at your account and watch numbers go down. That is part of the admission price. My goal here is not to tell you exactly what to buy tomorrow morning. My goal is to help you think correctly, because correct thinking is what protects you when emotions get loud. Let me start with the first one. If you want the broad American engine, the simple, blunt, durable approach, you begin with VU. VU gives you exposure to the S&P 500. That means you own pieces of 500 of the largest businesses in the American stock market. And I want to tell you why that matters. Because back in 2007, I made $1 million bet against a collection of hedge funds. The bet was not complicated. I said the S&P 500, low cost and passive, would outperform expensive, sophisticated hedge fund managers over time after all the fees were counted. The hedge funds had prestige, they had teams, they had models, they had analysts, they had every reason in the world to look smarter than a plain index fund, and over 10 years, the simple fund beat them. The hedge funds, after their fees, annualized roughly 2.2%. The S&P 500, after its tiny cost, returned about 7.1% a year. That is what so many people still fail to understand. It is not enough to be smart. It is not enough to have access. It is not enough to sound sophisticated. If the structure is expensive and the process is flawed, the ordinary investor buying a plain basket of great American businesses can still win. That is what VU represents. It is not glamorous. It does not give you the thrill of saying you found the next great company before everyone else. But the stock market is not there to entertain you. It is there to transfer money from the impatient to the patient. And VO is built for patience. There is another piece here that I want you to understand deeply. When you own the S&P 500, you are not freezing America in place. You are not buying 500 names and hoping each one survives forever. You are buying a self-renewing machine. Years ago, Sears was a giant. It was one of the great retail powers in America. It belonged in the S&P 500. Then Sears weakened. It lost ground. It stopped being one of the country's dominant public companies. And when that happened, it was removed and replaced. That is the beauty of the index. If you had owned Sears directly, you had to decide when to sell. You had to recognize decline. You had to admit you were wrong, or at least admit that the future no longer looked the way it once did. Many people never do that. They ride a stock all the way down because hope is easier than discipline. But inside an index, the weak get pushed out and the stronger replacements come in without you lifting a finger. You simply continue to own the largest 500 companies. If one stops qualifying, it leaves. Another takes its place. The basket adapts while you continue living your life. That matters because companies fail. People talk about the stock market as if every great name lasts forever. It doesn't. When the S&P 500 began in the 1950s, There were 500 original companies in it. Today, only about 50 of those originals remain. That means roughly 450 are gone. Some were acquired, some declined, some disappeared entirely. That is exactly why broad ownership matters. If you make your life about finding one superstar and clinging to it, you are taking on a burden most people are not equipped to carry. If you buy the broad engine and let it renew itself, you are putting the burden on the system, not on your emotions. Now, VO does one thing very well. It gives you broad exposure to the American economy. If America grows, if her biggest businesses continue earning more, innovating more, selling more, then this kind of fund tends to benefit. If America goes through a recession, it will go down too. Do not fool yourself there. Broad ownership does not eliminate pain. It simply gives you a better structure through which to endure the pain and participate in the recovery. So if VOO is the broad growth engine, the second ETF answers a different question. What if you want income? What if you like the idea that your portfolio should not only appreciate over time but also send you cash? That is where something like Sheiji enters the conversation. Now, let me explain the logic, because most people get dividends wrong. They chase yield the way desperate gamblers chase the next hot tip. They sort a stock screener by highest dividend and they buy whatever is paying the fattest percentage. That is one of the fastest ways I know to get hurt. A dividend by itself tells you very little. A weak business can pay a tempting dividend for a while and then cut it the moment pressure arrives. When that happens, you do not just lose income. You often lose capital too, because the stock price falls right along with the dividend cut. So the right way to think about income is not to ask, what pays the most today? The right question is, which businesses are strong enough to pay me today and stronger still 5 years from now? Take a company like McDonald's, as it generates enormous profits. Once a company produces large profits, it has only a few real options. It can reinvest in the business, it can save cash for rougher times, or it can return money to shareholders. One way it returns money is through dividends. That is all a dividend is. It is a share of profits flowing back to owners. But the important part is not merely that the company pays a dividend. The important part is whether the company can keep growing the profit base that supports that dividend. If profits grow, dividend capacity grows. If the business remains strong, that income stream can become bigger year after year. That is why a fund like SEG is attractive to many people. It is not just hunting yield, it is focusing on companies with long records of paying dividends, companies with real profitability, companies that are not merely flashing a high yield to seduce naive investors. Look at the kinds of businesses inside it. You are seeing names like Chevron, ConocoPhillips, Merck, Verizon, Coca-Cola, Pepsi, Texas Instruments, Abbott, Procter & Gamble. These are not moonshot stories. These are not the businesses people post about when they want to feel futuristic. These are businesses selling oil, medicine, communications, beverages, consumer staples, industrial products, things people continue buying in good times and bad. That is why the personality of SHD is different from VOO. VOO is broad America. SAG is a more focused collection of strong dividend payers, the kind of businesses built to produce cash and, ideally, raise the cash they return to owners over time. There is a discipline built into that process too, to qualify for inclusion. A company needs a substantial record of dividend payments. It cannot simply wake up one morning and pretend to be an income machine. It has to show durability in practice. That tends to screen out a lot of the noise. And that matters because when your goal is income, you should not be seduced by noise. You should want businesses with staying power. I also want you to notice what is not dominating a fund like this. You are not seeing the same heavy concentration in the most speculative corners of technology. That is not because technology is bad, it is because the mission here is different. The mission is steadier income, and steadier income growth, not maximum possible upside at any emotional cost. Now let me give you the blunt truth. SEC will still fall in a downturn. Do not buy any equity ETF under the illusion that it is immune to recessions, panics, or broad market fear. If the market is hit hard, it will feel it. But the character of what you own matters. Strong companies with real profits, companies selling necessities and essentials, tend to give you a more stable base from which to collect income and endure volatility. So now we have two pieces of the puzzle. VOO gives you the broad American machine. SAG gives you a more income-oriented approach built around quality dividend payers. But there is a third desire many investors have, and it is a powerful one: growth, aggressive growth. That is where QQQ comes in. QQQ gives you exposure to the NASDAQ 100, which means the 100 largest non-financial companies on the NASDAQ exchange in plain English. That usually means you are getting a lot of technology and growth exposure. These are the businesses investors expect to shape the future, especially in areas tied to software, semiconductors, communications, digital infrastructure, and the tools that drive productivity higher. That kind of exposure has made a lot of people rich over the last decade or so. QQ has averaged roughly 20% annual returns. Put that next to the historical 10% area many people associate with the broader market, and you immediately understand why people get excited. The upside has been extraordinary, but if you are going to own something like QQQ, you must understand the price of admission. Volatility, when technology is in favor, when optimism is high, when capital is chasing the future, QQ tends to move faster than the broad market. But when fear hits, when optimism is repriced, when the market starts punishing assumptions, QQ can fall hard. I want you to remember the dot-com collapse between 2000 and 2002. The NASDAQ 100 was crushed. A drop of more than 75% is not a theoretical inconvenience. That is life-altering volatility. If you owned it and did not understand what you held, you likely sold it. If you sold it, you turned volatility into permanent damage. That is the key with QQQ. If you own it, you must own it with the belief that technology will be more embedded, more necessary, and more productive in the future than it is today. If you cannot hold that belief through vicious declines, then you should not pretend you can hold a fund built around it. This is the great irony of high-growth investing. The return profile attracts people who are emotionally least prepared for the path required to earn those returns. They see the gains. They do not study the drawdowns. They imagine themselves as long-term owners right up until the market gives them the test. Then they fail the test, so I want you to think about these three funds. The right way: VO is broad American ownership. SAG is quality dividend-oriented ownership. QQQ is concentrated growth ownership with more upside and more violence along the way. None of these is magical by itself. The real question is not which one is best in the abstract. The real question is which one fits your temperament, your timeline, and your ability to behave correctly when prices stop cooperating. That is where most investors get hurt. Not because they picked a terrible asset, because they picked something their nervous system could not hold. And that brings me to the most important part of this whole conversation, because even if you choose the right fund, most people still sabotage the result. They wait for the perfect entry, they wait for certainty, they wait for a clear bottom, they wait for the moment that feels safest. And the market punishes that kind of waiting over and over again. I have watched this play out for years. In 2020, when the market collapsed with stunning speed, people froze. They said buying on the way down was foolish. They said conditions were going to get worse. They said the economy was imploding. Then policy shifted, liquidity flooded the system. And what looked like catastrophe turned into one of the fastest rebounds in history. In 2022, the market fell again, about 20% from peak to trough in the broad indexes. Same comment, same paralysis, same chorus of certainty from people who were sure things had much further to fall. Then 2023 arrived, and the market marched higher again. In 2025, tariffs hit. Fear exploded. In February, markets fell hard and people screamed that the economy was finished. Then policy softened and markets pushed to new highs. In March, fresh tariffs appeared, bigger this time. Markets dropped again. Same panic, then easing came and the market recovered again. Then came April and what people called Liberation Day, another major tariff event, another sharp global sell-off, and again after the pressure eased, the market found its footing. Do you see the pattern? The pattern is not that markets always bounce instantly. They don't. The pattern is that ordinary investors keep demanding perfect clarity before they act, and perfect clarity never comes. By the time the all clear feels obvious, much of the opportunity is gone. That is why I prefer a different philosophy. Always be buying. Buy when markets are high. Buy when markets are low. Buy when they are drifting sideways. Buy when people feel brilliant. Buy when they feel stupid. Buy under Republicans. Buy under Democrats. Buy when the weather is pleasant and buy when it isn't. The market does not care about your desire for emotional comfort. It rewards disciplined capital deployment over time. Now, that phrase "always be buying" only works if you structure it correctly, otherwise it becomes a slogan. Instead of a system, the right way is automation. You set up a recurring transfer from your checking account into your portfolio every week, every 2 weeks, or every month. It happens without asking your permission every single time. It happens when markets are cheerful It happens when markets are ugly. It happens when you are busy. It happens when you are tired. It happens when headlines say buy, and it happens when headlines say run. That is the point. The system is stronger than your mood in my own life. I have always believed that the best financial behavior is the behavior you make automatic. If you leave every investment decision up to your emotions in the moment, you are handing a very serious job to a very unreliable employee. Emotions are fine for romance. They are terrible for portfolio construction. So imagine the discipline this way. Money leaves your checking account every Wednesday or every first of the month or every other Friday. The day itself does not matter. What matters is that it happens. You are steadily acquiring ownership in productive assets while the world around you keeps searching for a dramatic story. That is how fortunes are actually built. Not with a heroic one-time move, not with some perfect trade, with repeated, almost boring good behavior. And then there is one exception, and it is the only one that matters. When markets go down sharply, you do not stop the system. You buy even more. This is where the serious money is made when broad basket funds fall, when fear is high, when prices have been marked down. That is not the time to panic. That is the time to become more aggressive if your financial foundation is secure, because lower prices mean your same dollars buy more units of the businesses you already wanted to own. I want you to think carefully about how strange human behavior becomes in markets. If televisions are discounted, people rush into the store. If great businesses are discounted, people rush for the exit. That is backwards. And it only feels reasonable because markets are public and noisy. If someone offered you ownership in part of America as greatest businesses at a lower price than last month, why would you become more frightened? You should become more interested, not less. The reason people fail here is not intelligence, it is conditioning. They have been trained to think price movement equals truth. Rising price means good. Falling price means bad. That is how gamblers think. Investors have to think differently. Investors have to ask whether value has changed, not whether price has moved. So let me simplify the whole picture. If you want broad exposure to America's biggest companies, VU is a serious tool. If you want income and quality dividend growth from stronger, steadier businesses, South Carolina HD deserves attention. If you want more aggressive technology, driven growth and can tolerate severe volatility, QQ has historically rewarded that patience. But the fund is only half the equation. The other half is behavior. Do you automate? Do you keep buying? Do you stop pretending you can call bottoms precisely? Do you have the emotional strength to buy more when the market is on sale instead of less? If you do, then these broad basket funds become powerful because they let you stop acting like a fortune teller and start acting like an owner. And ownership is the whole game. That is what people miss when they obsess over finding the next Amazon. They think wealth belongs to the person who predicts the future. Most of the time, wealth belongs to the person who consistently owns productive assets through time while other people keep talking themselves out of action. That is why broad ETFs have quietly created more millionaires than almost any individual stock story. They did not do it by looking sexy. They did it by being usable. They did it by allowing ordinary people to own extraordinary businesses in a repeatable way. They did it by helping investors survive their own worst instincts. If you are trying to build a portfolio that can survive 10, 20, even 30 years, then stop asking which stock will make you rich next year. Ask instead which system can make you wealthier if you follow it with discipline for the next 2 decades. That is a very different question, and it usually leads you away from excitement and toward structure, toward ownership instead of prediction, toward a process instead of a thrill. So here is the truth I would leave you with. The way most people lose in the stock market is not by buying terrible things. It is by buying good things with bad behavior. They buy and then doubt, they buy and then stop, they buy and then wait for certainty, they buy and then sell when the test arrives. Do not do that. Build the plan. Choose the tools that fit your temperament. Automate the purchases. Let time do what time does, and when the market finally gives you what it always gives serious investors. Eventually, a sale on good assets. Do not waste the moment trying to feel safe. Take it. That is how ordinary investors beat complexity. That is how broad ETFs quietly build serious wealth, and that is how more millionaires have actually been made than by chasing the next Amazon that almost nobody was going to find in time anyway.